Hi, ladies and gentlemen. It's James Marley here from Livewire Markets, and we are on the cusp of another reporting season. And last February, we invited Rudi Filapek-Vandyk, who's the editor at FN Arena, to talk us through his views on reporting season and share some of the experience that he's had analysing and watching and synthesising all the information that comes out of reporting season. I think it's fair to say that there are a few people that have spent as much time as Rudi trying to get across the numbers, and it's a really unique area of expertise and interest that he has. So I thought we'd get him back in for August. Obviously, there's been some big changes in the operating environment during that time. So I think it'd be great to check in with Rudi and see how he's approaching reporting season. So Rudi, great to have you back on, and thanks for joining us.
James, it's a pleasure to be here.
Great. Well, listen, I might start just by dialing back. You recently published an article on Livewire, which you titled "My 7 Secrets to Investment Success." And it was a distillation of a number of lessons that you picked up from running your own, the all-weather portfolio, as you call it, over the past 5.5 years. And we might touch on some of the performance of that in a moment. But the first thing that stood out to me was that quality beats valuation. That was your number one lesson. And we've seen that there's a big argument going on in markets about things being too expensive and when are they going to blow up. It's getting quite heated, quite emotional. Could you talk me through that view that you hold, that it really is quality that outperforms valuation?
James, I think I can illustrate this with a very simple example. We all could have bought CSL shares in the IPO in 1992, and that would have cost us around $3,000 at the minimum. If we held those shares until earlier this year, late last year, we would have been millionaires. So $3,000 becomes $1 million. If you are that type of investor that keeps shares for a long time, just ask yourself how much difference would it have made that in year 1 or in year 3 or even in year 5 of when you were holding those shares, that your shares were temporarily overvalued. And that's essentially the long and the short of my analysis. So it basically comes down to what type of investor you are. And if you are the type of investor that likes to hold shares for a really long time, then you have to realize that overvaluation is a temporary thing, as long as you have, of course, the type of company in your portfolio that increases value over time and continues to find growth. And I think that's the simplest example that everyone understands and I can put forward. On my observation, and I am going to insult a few people now and surprise the others. On my observation, if you buy cheap stocks, on many occasions, they only bounce temporarily. The way I compare them is this weekend I went to the supermarket. I won't name the name, and I saw the strawberries very, very cheaply priced. And what happens is I've now learned from the share market that if something is priced cheaply, there's something wrong with it. So I basically turned up all the punnets of strawberries, and almost every single one of them had one inside that had a little bit of mold to it. And that instantaneously made me realize, and that's why they're cheap. Right? And it's basically in the share market, you have to ask the same question. Right? Do you want to buy cheap strawberries that you basically have to eat immediately and you have to fish out the one with the mold? Or basically, if you want to stack up your pantry with some food that you don't immediately have to eat, you better buy good stuff, great stuff. And you know what? For quality, you pay. It doesn't mean that you never pay attention to valuation, of course, but it does mean that when you realize that you pay up for quality, that the PE ratio is not your measurement, that is not the only measurement that you pay attention to. I mean, if in a very simplistic term, people know I'm a big fan of CSL. I'm a long-term investor in CSL. What never stood up for me is that every time investors would say, you can't buy it, it's too expensive. And every year it goes up. So obviously there's something wrong with that narrative. And I think what's wrong with that narrative is that a reliable quality performer has a price attached to it. And it's not a low PE on a single digit.
Rudi, I think there would be not many people that could hold a good argument against your CSL example. It's proven itself over a really long period of time. I get the impression that the real frustration comes around companies with lower earnings and less proven business models. The buy now, pay later is an obvious market segment to highlight, but there are others. And I guess I'm keen to understand your distinction between a company like CSL and a company like Afterpay, where the track records are far different and the earnings profiles are not comparable.
Yeah. Maybe good to explain here. I'm not your typical growth investor. I'm a quality investor. But as the market evolves and as it has transpired, because I focus on quality, I am closer to growth than I am to value. And that's also means I understand growth better because I'm not looking for very cheaply priced assets. And okay, here's a very, very practical way of illustrating what I'm talking about. In 2015, I wrote this book. It's called Change. Yeah. I thought at the time that I better be quick in getting this out because I thought the financial world looks forward and they are going to be all on the case within no time. To my surprise, even today, there are hordes of investors out there that are paying almost no attention to the changes that are taking place in society. The fact is, when I wrote this book 5 years ago, I predicted that we would go through tremendous changes in society. And of course, those changes will have an impact on economies and on the share market. To my surprise, I underestimated the changes that were going to happen. Where a lot of, as I said earlier, I hope I'm not insulting too many people here, but where a lot of typical value investors, bottom-up value have gone wrong is they've completely ignored those tectonic changes that are taking place. And it's not that you mean that they're small changes. I mean, at the very least, societies are going through a transformation that is probably the biggest in hundreds of years. Even if that's not the case, it's definitely going to be the most transformative period in our lifetime. Right? And what I discovered while doing my research is that I had to create 3 or 4 baskets of stocks in the share market. And my first basket was high quality stocks that are immune or not affected by those changes that are taking place. Another basket would be stocks that are benefiting from those changes that are taking place. And that's, there you get in your first basket, you get the likes of CSL. In your second basket, you would get the likes of Afterpay that you mentioned. Now, the third basket would be reliable, solid, sustainable dividend payers. Right? And for example, you put a Waypoint in there, previously known as Viva REIT. The fourth basket is the ones that I've been avoiding for the past decade. And those are the laggards that have to transform, that will be hit, that will get the headwinds, and will find it increasingly difficult to maintain their profit level, their margins, and create value for shareholders. Those baskets have served me incredibly well in my views on the market. That's what I've been trying to communicate to investors as well. Now, admittedly, there is an element of low interest rates, which has created a gap which is even larger in between those baskets, because it has benefited the quality stocks and the beneficiaries of the changes and not the basket number 4. And then, of course, this year you get the pandemic, which again throws a lot of complications in those baskets. But in general terms, if investors had viewed the share market through those 4 baskets and had acted accordingly in their portfolios, they would have done much better than most would have done so far. And I'm saying this from anecdotal evidences and from the rankings I see and the updates I see from professional investors as well.
So Rudi, let's bring it into reporting season on that note. A lot of people are talking about this reporting season being a bit of a judgment day and the opportunity to recalibrate expectations. Is this the inflection point where bucket 4 starts to even or make up some ground on buckets 1, 2, and 3 and settle some of the score, or are those frustrated value investors going to feel more pain?
I think they're going to be frustrated for much longer, and that's unfortunately me. I don't shoot the messenger, but on my observation, they will be waiting for much longer. Yes. See, the ruling narrative over the past 2-3 years from that part of the investment community was the share market is crazy, investors are paying up too much for success stories. You wait until the next recession arrives and we will have our day under the sun. I have consistently been saying, no, you wait until we have a recession and you will still not have your day under the sun. Because what will happen in a recession, and what we've seen with the pandemic this year, is that the weakest companies get carted out first. And that's exactly what happened in the sell-off this year we had. The cheap stocks simply became a lot cheaper. And a lot of the so-called expensive stocks, deflated a little bit, but they were back before you knew it. And that's what you get in a time when you have these tectonic changes taking place. Investors want to be part of the future. And they don't want to be part of the laggards simply because they are cheap. Now, having said so, when we will get out of this situation, and that's a big question mark, if and when, but when we will get out of the situation, you will get a situation like 2009, for example, like the second half of 2012, like the first half of 2019, when the laggard stocks, the value stocks in the market, will have their moment under the sun. But that's only half of the story. The other half is that's because they've fallen more in the first place. And that's because when it's part of the economic recovery story, which always benefits the weaker ones and the laggards ones. But it's not a structural recovery story. And I think there's too much emphasis by too many people in the market on what the Federal Reserve does, on low interest rates, on what governments do in terms of stimulus. It's basically a low growth environment, and the weaker companies are finding it difficult to have consistency and reliability in their profit growth. And they're being punished for it, or basically they're being ignored for it. And it shouldn't be a surprise that just like you pay up for a premium car or for a premium handbag, for a premium jacket, a premium meal, you do pay up for premium companies in the share market, and there's a reason for it.
Well, let's run through a couple of the observations that I've picked out from your recent reports about the upcoming reporting season. You've said guidance has never been more important, particularly around earnings and dividends. Can you go into some detail on that point, and where are some of the areas that you're expecting certainty?
I think on a general level, August 2019, a year ago, was the worst profit season we had in Australia post GFC. I was amazed after last year that some commentators would denominate it as not too bad, and I thought, like, that's very subjective. This is the worst we've seen. February is very difficult to judge because we basically had the pandemic raging through it already, but it wasn't great, and we basically will now see a reporting season that is a lot worse than August last year. So we'll probably set some records here. What investors should be prepared for is that the cut in dividends will be at least double the loss in profits, and that is an indication of the fact that corporate Australia was not in great shape coming into this recession with pandemic, and also don't forget. Corporate Australia started cutting dividends already last year, and payout ratios moving into this situation were way too high, including for the banks, and they will come down. So you will get this double whammy where both the payout ratios will go down and the cash flows will be down, and the impact will be quite severe. Contrary to the GFC, this will not be done in 12 months. So we will have companies that will cut this year, or then we'll probably have to cut next year. And then maybe next year, the year after, we have different companies cutting their dividends. So we are creating a context where reliability again and sustainability are very precious words. They are rare to come by. So again, those companies that can provide us with certainty and with reliability in terms of you can trust us, we're going to pay you X amount, they will get a premium, I think, and they will be rewarded for it. To my surprise, the way the situation is panning out, one of the companies that has been quite a very mixed performer since listing is Telstra. And expectations are now growing that Telstra might actually crown themselves as one of the standouts this season for that particular reason, that they might be able to guarantee shareholders that they will have a certain payout and they won't waver from it, which might prove, because of the situation, might actually prove sustainable. And that might, for once, create a different benchmark for Telstra. But if I could have a quick look at the US, about between 1/5 or 1/4 of all the companies in the US have given a guidance, which is well below what usually happens, and about 1/3 of those has been negative. So you can see, and we've already seen that since February, that those companies that are able and willing to provide the market with concrete guidance, not just like we hope it's going to get better, they will actually be rewarded for it, and you see that in better share price performances. And investors will be on the lookout for this year, because it basically, if you think about it, all makes sense. It's about reducing your risk, and there are some standout dividend payers in the share market. Apart from Waypoint, which I mentioned earlier, you also have the likes of APA Group, for example. You have the likes of APN Convenience Retail. You will have the likes of an Horizon is also in there, for example. Amcor. These are all dividend payers that are expected to continue increasing their payout for not just this year, but also the years ahead. Of course, you will also have companies like CSL, ResMed, and a few other ones, but they do not necessarily feature on analyst radar because they trade in higher multiples, and then the yield is not high enough for your typical income investors to go for those shares.
Rudi, you also said that the market has developed a stomach for bad news, which means that bad news that you read in a report might not necessarily translate through to weak price performance.
Yes.
Put some more context around how people should be gearing themselves for bad news and trying to sort of correlate that with the market reaction.
Yeah. Nothing is as easy as calling a share market or a share price overvalued. I mean, on my observation, we've all been doing it as a community for years now, and every time we call a ResMed or a CSL overvalued, the impact seems to be quite temporary. I mean, the big lesson I've learned over the years is that the company with the high multiples that is moving in the share market on results and comes out with result is not necessarily the company that will come crashing down in their share price. I mean, it might temporarily happen, but there's not a correlation between high valuation, low valuations moving into the reporting season. You either disappoint or you don't. And given the context at the moment, there is a general sense that maybe the share market has gone a little bit too far, given what's coming, is that it's possible that investors will be on tenterhooks and become nervous. But I still think that that's the macro picture that is determining that, and we see something happen between the US and China, for example, or on the interest rate front or the bond market. But on the individual front, on my observation is that for 80% or so, prior to results, the share market gets it correct. So where ResMed is trading is probably correct, and where GUD is trading is probably correct as well. I mean, and there's quite that's quite a divergence between the two. I think that too many people are calling the share market overvalued because they actually underestimate how the share market works. And the best way to illustrate this is going back to the GFC. And in 2009, there was no indication whatsoever that we were going to have a quick economic recovery, yet share markets rallied from the lows in March, and they kept on rallying until early 2010. And that by then they had done their dough. So what basically means the share market now is trying to look forward, and I think investors are largely ignoring 2020 numbers, unless the indication is that things are not quite right internally with the company. And then, of course, you have to revise your view. But in general terms, I think you have two types of companies. You have the ones that have done well and are a beneficiary of what is happening, the likes of ResMed, Fish and Pickle Healthcare, Afterpay, Zip, and car sales, for example. They will be judged on any normal metrics as they've always been judged. Like, we've put your share price on a certain level. How are you performing? Can we trust you that the years ahead will be okay? The larger group is on lower multiples, and we know that their numbers won't be good. Right? We know. It's now about what don't we know so far. So they will have to convince us that the year ahead, maybe in 2 years, that they will be back at pre-pandemic levels, hopefully. And as long as they can convince us, we will probably put their share prices a little bit higher than where they are. If they sort of can't convince us, then again, there will be a value trap for the time being. And that's why I think, because that's the majority of the share market, that's why I think we can stomach bad news at this point, as long as we can keep the confidence that next year, at least in 2 years' time, those companies will be in better shape. And this is also why the balance sheet and cash flow will be now very, very important, because we don't care that a Qantas is only having a few planes in the air. We don't care that Sydney Airport, there's nothing happening there. What we do care is, can these guys weather it out? Do they have enough cash so they can start operating normal again by the time that things normalize again? And that's another element that investors will have to pay attention to. It's not about the bad news. It's about, will they survive and can they get back to normal?
Rudi, when I looked back at our article or our interview from February, one of the things that you said was you should never be afraid to sell, and it's never too late to sell. So that was before the pandemic had ripped through our economy, the global economy. So my question to you is, have you had to sell anything? Have you forced yourself? Have you changed your view on anything? Is there anything in there that wasn't all weather?
Yes, well, unfortunately, there's a few I regret selling, and there's a few I'm very happy I sold. See, here's one thing I learned over the years as well. One of the reasons why my all-weather concept works so well is that we are not living through normal economic circumstances. If you go back, and you go back to the late 2018, you go back before that, second half 2015, early 2016, before that 2011, first half 2012, before that 2007 until early 2009. We seem to have limited time when we have normal economic circumstances, and before we know it, we have these at least mini crises come along on a very regular basis. Now, what I learned from those crises is that every time you chuck out what hasn't performed in your portfolio or where your confidence is not very high, and it's sort of, your portfolio sort of goes through a cleansing operation every time, and it improves the portfolio each and every time. Now, that's the theory, and that's what I do every single time we go through those phases, 2018, this year, early in the year. So what I do is I chuck out, for example, a Jumbo Interactive, which I owned. I wasn't that confident anymore. At the moment, I'm glad I don't own it anymore. I have lots of other stocks that have done very, very well. I've sold out of a Atlas Arteria, for example, because I quickly established that they were not going to pay a dividend, and I had them for the dividend. So the reason fell away why I had them. Unfortunately, I also sold out of Macquarie, and that's one of them I came to regret. In early stage of what seemed to be happening, I thought these guys are in trouble. They have a lot of investments in infrastructure, including airports and the likes. I'm just as surprised as everyone else that the situation got resolved quite quickly, which then quite quickly resolved in a share price that recovered quite quickly. To be honest, I can only blame myself. Macquarie would still have been a buy last week, but you get that mental barrier that builds up. But investing is just like golf. It's not like having a perfect game. It's just having a game that's good enough for your score. And investing, it's the same thing. You will make mistakes. There will always be stocks that you would have liked in your portfolio or that would have sold earlier. But at the end of the day, with the stocks I own in portfolio, I feel I could absolutely not complain in 2020 and not in the years before either.
Rudi, I'm going to ask you for one or two stocks in a moment that you think can deliver this reporting season. Before we do, I'm keen to hear your view on gold equities, given the level of interest that there is right now, and it's something that seems to be proving a bit of a bright spot and a good all-weather style part of the market at the moment. But doesn't seem to fit the traditional buckets that you've put in there.
Well, I'm going to surprise you then, because I was about to respond by you asked the right guy. But again, you will find that I approach gold as an investor and not so much as a trader or as a short-term investor. See, the largest holding in my portfolio this year was gold, and I'm quite happy with how it has performed. I mean, that's performed.
Was that
well.
Directly in the commodity or via?
No. So I bought an ETF. So I go for gold and not for gold equities. And the reason for that is that I already have complications because I'm buying gold in US dollar and I already have the complications of the Australian dollar. I do not need even more complications where I get individual company risk as well. And you will find, for example, that some gold stocks have performed absolutely fantastically this year and some have not. And that's the risk that I don't want in my portfolio. You will go through times when having exposure through the share market relies on different dynamics than simply having exposure to the commodity itself. And I'm a lower risk investor, and I just wanted to have it because of all the other stuff that was happening in the world. And so basically, early in the year, I made gold my largest holding in the portfolio. But it's simply by buying an ETF, allocating that money, and just keeping it there. I'm not trading in and out, and I'm not seeking exposure through the share market either. And I'm keeping my holding, by the way.
Can you explain to our viewers and me why you've chosen to have that position denominated in US dollars?
Well, it doesn't matter whether you buy it in US dollar or in Aussie dollar, because ultimately you always get the conversion risk from the $8. So that doesn't really, that's just a personal preference, but it doesn't really matter because ultimately you have to buy in and buy out at some point, and the conversion is always there, even in allocating your percentage and return. So that's not the point. I think the major the decision you have to make is: do you buy gold, pure gold, or do you buy gold producers? And on the right hand side, the gold producers, you are taking on a different type of risk. And I'm just went for simple, straightforward, and uncomplicated.
Alrighty. Finishing up, last question. Outside of CSL, which we know is your bellwether go-to stock for reporting season, what are a couple of stocks that you're looking forward to reporting?
Well, I own stocks like REA Group, Car Sales, NextTC, Appen, ResMed, Fish and Pickle Healthcare. So you can tell from and more, of course, but you can tell from that group already that the portfolio has performed well this year. Now, I know from experience that doesn't mean that any of those stocks is setting themselves up for a big sell-off post report. So I'll definitely be paying attention by how well they are performing and whether I maybe should take a little bit off or add a little bit more to those stocks, because I'm still convinced that all of them I just mentioned have still a long runway of growth ahead of them. It's just that I have to pay attention a little bit to the short-term dynamics there. And then I have other stocks which have not necessarily shut the lights out, and they're a little bit in that laggard camp, although not at extreme cheap levels, which if they were would make me worried that something nasty might be coming up, and I have to pay extra attention. But there are stocks which I believe are still representing good entry points, good operational prospects, etc. It's just that it hasn't been priced in so far. We're talking about stocks like an Amcor, for example. We're talking about stocks like a Bapcor, for example. Those are the ones that immediately come to mind. I have a few other ones. I also have Aurora, by the way. And they are definitely going through a little bit of a challenging time in the United States, but they are, for the time being, going to pay more to shareholders, and that's probably gonna keep that share price supported. I also have stocks like a Ramsay Healthcare, for example, and they're holding up quite well, and I suspect that once we're opening up in Victoria and other regions, that they should do well. Again, I basically pay attention to all of them because I own them and have to make a decision whether I still want to own them post the reporting season. Most of those companies I own, I tend to own not for a very brief time. I tend to own for a longer time. And the assessment I have to make is whatever they come out with in August, is that going to be enough to keep those prospects alive for years to come?
All right, Rudi. Well, listen, thanks for sharing all of sort of your views and opening up on some of the stocks that you're holding and some of the ones that you're watching out for. If I'm to summarise your view on reporting season, you're telling people don't expect to get too many bargains for the good stocks. You're probably going to have to pay a little bit up for those earnings. Market is already expecting bad news, so don't be surprised if bad news doesn't see a big downside reaction. And the other thing that you're looking for is certainty. Those companies that can provide concrete guidance about their earnings and their dividends are likely to be rewarded handsomely. Is that correct?
I think that's very correct, and yes, well, I think you summarized it quite nicely. And don't assume automatically that a stock that has performed well, that the only way is down. Often there's more to come.
Okay, great. Rudi, thanks for jumping on the call. For all the Livewire readers, we'll be publishing Rudi's reporting season monitor every weekend on the Livewire website. It provides a full summary of the stocks that are reported, the key highlights from their result, and whether or not they were upgraded or downgraded. It's a really great resource that Rudi puts out. You can check it out, obviously, on the FN Arena website, and we'll have it on Livewire as well. Rudi, thanks again.
Beautiful.